So what we're seeing right now with the carriers, there is a tremendous number of blank sailings. So there is overcapacity in the market based on demand, and carriers are working to continue to blank sail, eliminate space, to try to continue to drive pricing to more compensatory levels.
Hi there, my name is Gregor Manatidis. I'm the Director of Marketing here at Navia. In this video, we're going to talk briefly to some of our team members around the globe and get some insights on the freight markets, what shaped them in 2025 and what you should expect as a supply chain leader in 2026. Hi Dave, thank you for joining us. Pleasure as always. I just want to start off by asking you, from your perspective, being our CEO in the North America markets, what are the top 3 trends that defined 2025 for you last year?
Yeah, Greg, great to be here. Appreciate the invite. I think the number one trend, which I'm sure everyone would agree to, is the turmoil that was caused with the ever-changing trade policies here in the United States. So the introduction of the multiple different types of tariffs, and just the constant change that we saw over the last 7 or 8 months has really kind of had importers take a strong pause to try to truly understand what more of a long-term solution might be. So they began to approach things more from a short-term perspective. They tried to move a lot of product in to increase their inventories when there was a reprieve or a pause on those tariffs throughout the course of the last half a year. But really that drove a tremendous up and down cycle here in the U.S. from an import perspective. The other key issues that we continue to see an impact on are the geopolitical issues around the world that continue to prevent vessels going through the Red Sea and the Suez Canal, which again is taking quite a bit of capacity out of the global markets, and extended lead times and supply chain transit times across the board.
Beautiful. So what I'm hearing is shorter term thinking, stocking up when there is a reprieve in high tariffs, and then obviously the disruption that everyone's seeing across the whole geopolitical space. Pardon me.
That is right. Yeah, absolutely.
And then I guess taking a look ahead, I presume there's probably going to be some more of this, but what are you foreseeing in the first 3 to 6 months of 2026 for our customers?
Yeah, I mean, so unfortunately, it's a little bit of more of the same.
Yeah.
So right now, what we see here in the U.S. is that most companies have an elevated inventory here in the U.S. And once we really kind of finalize the holiday season, which is just now wrapping up, which was forecast to be pretty strong with high consumer spending driven by the wealthiest of households. Companies will need to reevaluate, and what we are seeing is there is not a very strong indication that they will begin to replenish their stock. They're going to manage their stock because of the uncertainty that's still in that trade compliance and customs world. So they are still taking more of that short-term approach until they can get, again, a little bit better perspective on U.S. trade policy for 2026. The other thing that we're seeing is, when we look at demand is really not strong at the moment. It's not forecasted to be strong for the first 4 months of next year. In fact, many of the forecasts are expecting up to a 10% decline in year-over-year volume in Q1 of 2026 versus 2025.
Right.
So what we're seeing right now with the carriers, there is a tremendous number of blank sailings. So there is overcapacity in the market based on demand, and carriers are working to continue to blank sail, eliminate space, to try to continue to drive pricing to more compensatory levels. We did have a successful GRI go in mid-December.
Okay.
We are expecting a successful GRI to go into effect on January 1st. Looking at then the lead up to Chinese New Year, we expect the carriers to do everything in their power to maintain a rate level of about $3,000 to U.S. West Coast, $4,000 to U.S. East Coast. That may fluctuate down some, but the carriers are doing everything they can to continue to have stronger rates leading into Chinese New Year, and then getting into the end of February, March timeframe at TPM.
Yep.
Where most of that negotiating with BCOs and large NVOCCs takes place for the upcoming contract season. So they want that rate higher.
Just have a higher starting point.
Yeah, I mean, what we continue to hear from a lot of our partners is that the expectation for the 2026 contract year is that rates should remain about the same level that we saw in 2020.
We're saying the same thing here.
You know, that's kind of what the initial indication is, and we think that carriers will continue to try to push that rate to a level so it definitely benefits them more so in the negotiating process.
Very, very interesting. It'll be interesting to see how it all folds out. Appreciate your insights as always, Dave, and we will talk to you next time.
Absolutely, Greg. Thanks so much. Appreciate the invite.
Okay, everyone, I'm joined by Yannis Papanthimos, who is our head of ocean product here in Australia. Let's start off with doing a quick review in, a few sentences. What were the trends that you saw in the ocean freight market here in Australia in 2025?
So 2025, generally speaking, did not make us any wiser regarding Oceania, mainly because unlike what has happened globally with tariffs and major disruptions with the Suez Canal being still in place, I would say that for Oceania it was pretty much a rather dull year. Not that we didn't have issues, that's not the case, we did have, however not to the extreme that other trades might have experienced globally. Mainly we did experience delays that were related with the congestion at main Chinese ports, namely Shanghai and Ningbo, and we have seen those congestions being there for quite a long time. Similarly, we had issues regarding our European services for same reason, meaning some sort of stable, let's put it this way, congestion on the major North European ports, and as such disruptions were happening regarding Oceania. Another issue that we are becoming more and more accustomed here in Australia, especially, is weather-related events. And although they were quite sporadic, however, especially in the East Coast and mainly in Queensland and New South Wales, we did experience over the last 12 months a lot of disruptions that were due to weather-related issues, which unfortunately there's not much any of us can do. So again, to summarize, it was, I would say, a year that was quite close to being considered as normal or as the new norm is supposed to be. Looking at our crystal ball, we would expect, I would use the word similar year. However, obviously, one thing that we're definitely keeping our eyes on is what is going to happen on the Suez Canal. There are strong indications that if not all carriers, at least some of them, will try and start using the Suez Canal again after 2 years. Obviously, this is going to create some congestion at the beginning, especially on the loading side of things, meaning at Europe, which might cascade also into Oceania in a lesser degree. However, we do expect that to happen at some stage within 2026. The first months of the year are going to be pretty much dictated by the Chinese New Year being quite late, mid to late February for this year. So we do expect January, especially the second half and most probably first half of Feb, to be quite strong in terms of volume, because
everyone's trying to get
customers will be bringing in, will be front loading in order to avoid the Chinese New Year closure. Then though, there are a lot of factors that unfortunately we don't know at this stage that are going to shape how things will go demand-wise for the next year. Is there going to be an increase on the interest rate? That remains to be seen. What is the average economic power, let's put it this way, that the average Australian consumer is going to have? That's still something that we don't have enough data in order to make a statement. However, unless something unforeseen happens, 2026 should be similar to 2020, 2025.
Awesome. Thank you very much for that, Yanni. Really appreciate your time as always, and we will talk to you next time.
Thanks, Rick.
Some great insights there from our team members. If you liked this video, please subscribe, like on YouTube and LinkedIn. We will be uploading our monthly freight market update as usual throughout the rest of 2026 to give you the insights that you need to make better, smarter supply chain decisions. Thank you, and we will see you next time.